Are you a disabled veteran who thinks your benefits are completely safe from the taxman? If you're relying on old knowledge, you could be leaving thousands of dollars on the table, or worse, setting yourself up for an unnecessary headache with the Internal Revenue Service. The relationship between the VA, military retirement pay, and the IRS has undergone a fundamental, confusing, and frankly, life-changing shift over the last few years. This isn't just about filing tax-free income. It's about navigating complex concurrent receipt rules, leveraging new court rulings, and understanding why the IRS is suddenly paying much closer attention to how you report your income. We're diving deep into the 7 critical shifts in how the IRS now treats disabled veterans, and one of these changes could entitle you to a massive refund you didn't even know existed. The first critical shift, and the one that causes the most confusion, is the fundamental conflict between how the VA defines compensation and how the IRS defines income. For decades, VA disability compensation has been clearly excluded from gross income. This is a bedrock principle. But the moment a veteran receives both military retirement pay and VA disability, a situation known as concurrent receipt, the lines blur and the IRS steps in. Military retirement pay is generally taxable, but when a disability rating offsets that retirement pay, the portion attributed to the disability becomes tax-exempt. The shift isn't in the rule itself, but in the intensity of the scrutiny. As more veterans qualify for concurrent receipt, often due to increased disability ratings later in life, the IRS is now demanding clearer documentation on the exact dollar amounts shifted from taxable retirement to non-taxable disability. This shift forces the veteran to proactively prove the exclusion, rather than the IRS simply accepting the VA's designation. If you receive a 1099-R showing retirement pay, but a portion of that was waived for disability, the IRS needs to see the specific VA documentation proving that waiver, and they are becoming far less forgiving if the numbers don't match up precisely. On your return, this is the foundational trap, assuming the two agencies communicate seamlessly when they absolutely do not. The second major shift stems directly from recent legislative actions, particularly the expansion of presumptive conditions. When Congress passes massive acts like the PACT Act, which dramatically expands the list of conditions presumed to be service-connected, hundreds of thousands of veterans suddenly become eligible for VA disability compensation, often retroactively. This influx changes the IRS's landscape entirely. Suddenly, the IRS isn't just dealing with a steady trickle of new disability claims. They are facing a flood of veterans who are receiving massive, multi-year lump sum payments. Because these payments are retroactive, they often correct previous years where the veteran was paying taxes on retirement pay that should have been classified as tax-free disability. The IRS's internal guidance had to rapidly evolve to handle this volume. Before these legislative pushes, retroactive corrections were handled on a case-by-case basis, often relying on complex amended returns. Now, because of the sheer scale, the IRS has had to formalize and streamline the process for correcting past tax returns, effectively creating a new, separate track for handling veteran disability back pay. This massive legislative catalyst is why the IRS is now treating veteran tax situations differently. It's a matter of volume and necessary administrative procedure. But the biggest, most financially impactful shift came not from Congress, but from the courts, leading to our third critical change, the judicial shift and the refund revelation. For years, there was ambiguity regarding how the IRS treated specific types of disability income, especially when the veteran was required to waive a portion of their military retirement pay to receive VA disability. This ambiguity was largely resolved by specific guidance, often influenced by landmark cases like the Bivens situation, which dealt directly with the taxability of payments received after a veteran's disability rating was increased and made retroactive. The core revelation is this: If you previously paid taxes on military retirement pay that was later converted to VA disability compensation through a retroactive rating increase, you are entitled to a refund. This sounds simple, but the IRS previously made it incredibly difficult to claim these refunds, sometimes denying them based on statute of limitations. The current treatment is different. The IRS has been compelled to clarify that the statute of limitations for amending returns related to service-connected disability pay is generally extended or waived in these specific circumstances, recognizing that the disability determination itself often happens years after the initial tax year. This clarification means veterans now have a viable path to reclaim taxes paid potentially a decade or more ago. This is not a small adjustment. This is a direct recognition that past tax treatment was flawed, forcing the IRS to implement new, specific procedures just for veterans seeking these retroactive corrections. This leads directly into the fourth shift, the handling of retroactive compensation, or the back pay puzzle. When a veteran receives a large lump sum payment covering several years of retroactive disability pay, the IRS has specific requirements. They don't just want you to report the lump sum as non-taxable income in the year you received it. They need you to understand that this payment relates to prior years. If you were paying taxes on military retirement during those prior years, the IRS now mandates a precise calculation to determine the exact amount of overpaid tax for each specific year. This requires filing Form 1040-X, the amended return, for every single year the back pay covers, even if those years fall outside the normal 3-year window. The new treatment involves the IRS assigning specialized agents or units to process these veteran-specific amended returns, recognizing the complexity of splitting a single payment across multiple tax periods. The old way was a bureaucratic nightmare, often resulting in blanket denials. The new way, while still complex, acknowledges the veteran's right to that refund and provides a clearer, albeit paperwork-heavy, pathway. Crucially, the IRS now expects documentation showing the precise amount of retirement pay waived for each year, not just the total VA award. Our fifth critical shift involves an unexpected downstream effect, the dependency dilemma, and how tax credits are now affected. While the primary goal is maximizing tax-free income, the increase in non-taxable income can sometimes unexpectedly impact eligibility for certain refundable tax credits, particularly those related to earned income, such as the Earned Income Tax Credit, EITC, or specific child tax credits. Since VA disability compensation is not considered earned income, a veteran who switches from a taxable military pension to a tax-free disability may see their reported earned income drop significantly. If their earned income falls below the threshold required to maximize certain credits, they might actually receive less money back from those credits, even though their overall tax liability is lower. The IRS is now treating this scenario differently by providing clearer guidance on what counts as earned income versus non-taxable income, ensuring veterans understand this trade-off. For example, specific guidance has been issued regarding how certain combat-related special compensation, CRSC, which is also tax-free, interacts with the definition of earned income for credit purposes. This requires veterans to perform a delicate balancing act, optimizing for both tax-free status and credit eligibility, a complexity that didn't exist when most of their income was simply categorized as taxable retirement pay. The sixth and perhaps most often overlooked shift is the myth of automatic exclusion. Why veterans must still file specific forms and provide specific proof. Many veterans assume that because the VA and the Department of Defense, DoD, communicate, the IRS automatically knows their disability status and the exact amount of their tax-exempt income. This is categorically false, and the IRS is cracking down on sloppy reporting. The new treatment demands proactive documentation. If you receive a 1099-R that includes amounts waived for disability, you must attach the specific letter from the VA or DoD explaining the waiver. If you are receiving combat-related special compensation, CRSC, which is entirely tax-free, you need to ensure that amount is explicitly excluded from your gross income calculation and documented clearly. The IRS now requires specific notations or forms, such as Form 8886, Reportable Transaction Disclosure Statement in certain complex situations, or simply the careful use of the exclusion lines on the Form 1040. Failure to document the exclusion properly means the IRS computer system flags the discrepancy between the 1099-R and your reported income, triggering an automatic audit notice. The shift here is from passive acceptance to active proof. The burden of verification now rests squarely on the veteran. Finally, the seventh critical shift involves planning for the future. New strategies for disability income and retirement. Because a veteran's income stream is now potentially much more heavily weighted toward tax-free disability compensation, the IRS is indirectly influencing financial planning. Veterans need to adjust their withholdings, W-4, immediately, often reducing them to zero or claiming far more allowances, as a significant portion of their income is now protected. Furthermore, the new treatment influences how disabled veterans approach retirement savings vehicles, like the Thrift Savings Plan, TSP, or IRAs. Since their current income is tax-free, traditional pre-tax retirement contributions, like the traditional TSP, become less appealing, as they are essentially deferring tax-free income into a taxable future. Conversely, Roth contributions, which are funded with after-tax money but grow tax-free, become immensely more valuable. The IRS hasn't changed the rules on Roths, but the shift in veteran income classification makes the Roth strategy the optimal path for many disabled veterans. The IRS's updated guidance implicitly encourages this type of strategic financial planning by clearly defining which income streams are protected, forcing veterans to rethink traditional financial advice based on their new, unique tax status. In summary, the IRS is treating disabled veterans differently today because of three converging forces: mass legislative changes that created a flood of retroactive claims, judicial rulings that clarified and extended the refund window, and the easy, administrative necessity of dealing with complex concurrent receipt scenarios. The old rules were ambiguous and often detrimental to the veteran. The new treatment, while still complicated, provides a clear path to financial justice. Your immediate takeaways must be twofold. First, if you received military retirement pay that was later converted to VA disability, you need to revisit your past tax returns, potentially going back over a decade, to claim the refund you are owed. Second, moving forward, you must meticulously document every dollar of tax-free compensation and ensure your tax preparation is proactive, not reactive. Do not rely on the assumption that the IRS knows your status. You must prove it. Understanding these 7 shifts is the difference between keeping your hard-earned money and inadvertently handing it back to the government. This is your money earned through sacrifice. Make sure you are using the new IRS playbook to protect every single dollar.